Welcome to another case study by Blueprint to Escape. Think about looking at the dashboard of your car while you're, driving down the highway.
Oh, yeah.
The speedometer gives you a very clear, immediate number, like you are going exactly 60. It's unambiguous, and it feels like all the information you actually need.
Right, it feels complete.
Exactly. But that single number tells you absolutely nothing about how hard the engine is working under the hood or, how much fuel you're burning to maintain that speed.
Or if the transmission is secretly under immense strain.
Yes, exactly. And today, we are taking that exact same concept and applying it to income-focused investments. In this space, the yield percentage is the speedometer, and the underlying fund mechanics, well, that's the engine.
That dashboard analogy is actually the perfect lens for what we're doing today. I mean, a high yield is comforting to look at, sure. But if you don't understand the mechanics generating that cash, you might be driving a vehicle that is slowly breaking down its own engine just to keep the speed up.
Which brings us to the mission for today's case study. We are analyzing and comparing two very distinct harvest ETFs. We've got HTA, which is the Harvest Tech Leaders Income ETF, and HHIS, the Harvest Diversified High Income Shares ETF.
Two very different beasts.
They really are. We want to evaluate their performance specifically based on long-term total return goals, with serious investors in mind.
All right.
The overarching objective here is to weigh the trade-offs. We're looking at the core stability that HTA provides versus the distinctly high-yield income generated by HHIS.
And figuring out how they actually fit together over the long run.
Exactly. Where should a serious investor lean right now?
It's a critical question, especially given the market conditions we've seen leading into May of 2026. I mean, the technology sector has been highly dynamic, right?
Absolutely.
And how these two different financial mechanisms capture that movement or, fail to capture it is incredibly revealing.
Definitely. But before we start opening up the hood to look at those mechanisms, just a quick reminder. This case study is for educational and entertainment purposes only.
Yeah, we have to say it.
Right. It's not financial, tax, or investment advice. These ETFs are not sponsors. They're just the subjects of today's research. We always suggest you conduct your own research, and you can simply speak to a professional if you need help aligning any of these concepts with your personal goals.
It really just comes down to understanding your own risk tolerance and your timeline.
Right, exactly. And to set the scene for you, heading into May 2026, these two ETFs already make up a notable portion of the Blueprint to Escape portfolio.
Which makes this very relevant.
It does. HTA currently sits at about 10%, and HHIS represents 12%. So we have a real stake in figuring out how these components interact. Okay, let's unpack this. Let's start by looking at the tail of the tape, the surface-level metrics for both.
Let's begin with HTA. How is the market currently valuing the veteran of the two?
Well, HTA has been around since 2015, so it has history. Currently, it holds roughly 807 million Canadian dollars in assets under management.
That's a solid chunk.
Yeah, and trading mid-May 2026 around $21.20, it offers a yield of about 8.40%. In the income investing space, HTA is largely viewed as the conservative, stable play.
The reliable hybrid vehicle.
Exactly. It's that well-tuned hybrid. It gets you where you need to go with a very smooth ride. Then we have HAS.
The newcomer.
The heavyweight newcomer, really. It only launched in February of 2025. Yet, in an incredibly short amount of time, it has rapidly accumulated double the assets of HTA.
Wow.
Yeah, we are talking 1.65 billion Canadian dollars in AUM. It trades at around $11.87 and presents a massive yield of 26.53%.
That's a huge number.
It's staggering. Going back to our vehicle analogy, HHIS feels like a turbocharged drag racer. You're producing this massive output. But looking at that AUM difference, I have to ask, are investors just blinded by the glow of a 26% yield?
That's the big question.
Is there an actual structural reason it deserves double the capital of a proven decade-old fund like HTA, or is it literally just yield chasing?
What's fascinating here is that it's primarily capital flowing toward immediate cash flow. I mean, Harvest has constructed a product that meets a very specific, aggressive demand for high monthly distributions.
People love their monthly cash.
They do. But if we step back and look at the philosophy of long-term investing, well, yield is only one piece of the puzzle.
Right.
A 26% yield means very little if the underlying asset is quietly eroding underneath you. Total return, which combines your cash yield with the preservation of your actual capital, is what dictates whether your portfolio survives over the decades.
Yeah, so if HHIS has double the money and triple the yield of HTA, we know there's no such thing as a free lunch. What exactly is HHIS doing with that capital? to squeeze out 26% that HTA refuses to do.
Let's get under the hood.
Let's decode their internal rules, and we'll start with HTA. So HTA provides exposure to 20 of the largest global technology companies.
They play.
Yeah, AMD, Alphabet, Broadcom, Texas Instruments, companies of that caliber. But the prospectus specifically notes it is equally weighted, targeting about 5% for each company.
Which is a very deliberate choice.
Why go through the trouble of equal weighting, though? Why not just let the biggest companies like Apple or Microsoft dominate the fund like a standard index?
Because equal weighting creates an automatic, disciplined system of buying low and selling high. I mean, think about a standard market cap weighted index.
Like the S&P 500 or something.
Exactly. If a single stock like NVIDIA goes on a massive run, it takes over a huge percentage of the fund. You become completely reliant on one company.
Which introduces a lot of risk.
Yes. Equal weighting forces the fund managers to regularly trim their winners. They take the profits from the stocks that surged and reinvest that capital into the solid companies within the fund that might have temporarily lagged.
So they're constantly rebalancing.
Right. It prevents the fund from becoming top-heavy and significantly reduces single-stock risk.
That makes a lot of sense for core stability. Now, the other major component of HTA is that it uses a covered call strategy to generate its 8.4% yield.
Yes, the income engine.
Now, for a listener who just looks at the yield percentage and, doesn't trade options, what exactly is happening behind the curtain? How does a covered call actually generate cash?
Think of it like real estate. Selling a covered call is a bit like owning a house and signing a contract that says you agree to sell your house next year at today's price in exchange for a large pile of cash right now.
So the premium.
Exactly. You collect that premium up front, which is great for immediate income. But if the housing market suddenly skyrockets and your house doubles in value,
You miss out.
you miss out on all that extra profit because you already agreed to sell it at today's price. You have effectively capped your upside potential to generate steady, predictable cash today.
So HTA is doing that, but the documentation says it uses a less aggressive covered call right. So they're only writing those contracts on a portion of their holdings, leaving the rest to grow naturally with the market.
Which is key for capital growth.
And finally, HTA is CAD hedged, which simply means it employs financial instruments to protect Canadian investors from fluctuations in the U.S. dollar. If the U.S. dollar drops compared to the Canadian dollar, HTA investors don't feel that headwind.
Which again leans entirely into the theme of core stability. I mean, they're buffering against tech volatility with equal weighting, buffering against flat markets with modest covered calls, and buffering against currency risk with hedging.
It's a very defensive posture for a tech fund. Now let's decode HHIS because the architecture here is wildly different.
Oh, completely different.
HHIS is essentially a fund of funds. It doesn't hold tech stocks directly. It holds Harvest's single stock ETFs. And to get that 26% yield, it employs about 25% leverage.
That's a huge factor.
It also utilizes an aggressive 33% covered call right, and it is CAD unhedged. Now, if I'm an investor relying on a fund for monthly income, hearing the word leverage usually sets off a few alarm bells regarding my principal.
Understandably so.
How does 25% leverage practically work inside an income fund?
Well, it amplifies everything, both the good and the bad. The fund is essentially borrowing money to buy more shares of its underlying assets.
So,
By holding more shares, they can write more covered call contracts. More contracts equal more cash premiums, which pushes the yield up to that massive 26% mark.
but what is the downside? I mean, there's always a downside.
The downside is that if the underlying technology stocks drop in value, your losses are amplified by that same 25%.
Ouch.
Yeah. Furthermore, if the market drops and the fund needs to keep generating that massive 26% yield, they have to write new covered calls at those new lower stock prices.
So they're locking in the bottom.
Exactly. If the market suddenly rebounds, their upside is capped at the bottom, making it incredibly difficult for the share price to ever recover its previous highs. It's a structural drag on the capital.
Which makes a major structural change they made in late 2025 quite concerning, I think.
The Q4 shift.
Yeah, in the fourth quarter, HHIS underwent a significant revamp. While they still hold standard heavyweights like Alphabet, Amazon, and Apple, they intentionally injected highly volatile, meme-adjacent, and fintech stocks into the mix.
Right.
We are talking about adding entities like Circle, Coinbase, Reddit, Robinhood, and SoFi. They built them up to a 2 to 3% target weighting. They also boosted Eli Lilly during an August pullback, Why would a fund dedicated to paying steady income suddenly pivot to high volatility names like Reddit?
If we connect this to the bigger picture, it's a direct requirement of their yield target. In the options market, volatility is the main ingredient for high premiums.
Yeah.
The more a stock's price violently swings up and down, the more an option buyer is willing to pay for a contract. And therefore, the more an options seller like HHIS can collect in cash.
So they are trading the steady, broad sector growth that HTA captures through equal weighting for a mechanism that purposefully seeks out turbulent price action just to harvest the cash.
Yes, exactly. By introducing entities tied to blockchain technology and volatile retail trading platforms, HIS is deliberately increasing its exposure to high implied volatility.
But remember the leverage.
Right. By using 25% leverage and an aggressive 33% call right on those highly volatile constituents, HHIS becomes heavily reliant on the price movements of those specific trendy sectors.
So if crypto takes a hit,
If crypto takes a hit or retail fintech enters a slump, the leverage and the aggressive call writing compound each other. It creates a significant erosion of the underlying capital.
that brings us to the ultimate test. Now that we understand the deep mechanical differences between these two funds, how did these strategies actually perform in the real world during the recent technology sector recovery?
The numbers are revealing.
Let's look at the mid-May 2026 data. We'll compare them against each other and against a pure benchmark, the iShares XQQ, which effectively represents the NASDAQ Technology Index without any covered calls or leverage.
This is where we separate the theoretical mechanics from the actual results.
Let's look at total return first. This is the metric that includes both the cash distributions paid out to the investor, plus the change in the share price. If you just look at the one-year total return, they both look like absolute winners.
They really do.
HTA delivered 32.58%, HHIS delivered 30.44%, the pure XQQ index was at 33.84%.
Pretty close.
And over a 3-month period, HTA gave 18.90%, HHIS jumped to 21.99%, and XQQ was 16.85%.
On the surface, an investor sees those numbers and assumes both funds are successfully riding the tech wave while handing out cash.
Here's where it gets really interesting. Let's strip away those monthly cash payouts. Let's look purely at the price return, the actual capital appreciation of the ETF share price itself.
The engine's true health.
Exactly. When we do this, we uncover the hidden cost of that 26% yield. Over the last year, the price return for HTA was up 20.6%. HHIS, over that exact same year, grew by 0.51%.
Wow.
It was completely flat. The pure XQQ index, for context, grew its price by 33.51%.
A 0.5% price return over a year where the broader technology sector grew by 33% is a glaring indicator of structural drag.
So HHIS is essentially treading water. And we see this even in the short-term metrics. The 1-month price return for HTA is 14.84%, which actually beats the pure XQQ index at 12.43% for that month.
That's impressive for a covered call fund.
It is. Meanwhile, HHIS lags behind at a 9.3% price return. What exactly caused HHIS to flatten out so severely over the year while HTA thrived?
It's the exact combination of mechanics we just broke down. HTA operates like a rock star in a recovering market because equal weighting allows it to capture growth across all 20 of its companies without being dragged down by a single failure.
Because it's not leveraged.
Right. And because it uses a less aggressive option strategy, it doesn't sell off all of its upside potential. It's preserving the underlying capital while participating in the broader market's upward trajectory. It tracks much closer to the XQQ index over the long run.
While HHIS suffered the consequences of its key four shift.
Exactly. That flat one-year price return demonstrates that HHIS suffered heavily from the slump of those highly volatile blockchain and fintech constituents.
The Coinbases and Robinhoods.
Yeah. When Coinbase or Robinhood drop, the 25% leverage deepens the hole. When they try to recover, the aggressive call writing caps their rise. HHIS generates cash by constantly shaving off its own ability to grow.
It's burning the furniture to keep the house warm.
That's a good way to put it. Now, it has certainly recovered nicely over the last 3 months as those volatile sectors bounced back. But its mechanical structure simply prevents it from achieving the steady capital appreciation we see with a fund like HTA.
So what does this all mean? How do we take these underlying mechanics, acknowledge the stark difference between total return and price return, and apply them to a serious investor's strategy?
Well, it requires aligning the financial instrument with the ultimate goal of the portfolio. If the goal is strictly immediate, maximum cash flow, and you are totally comfortable with your principal remaining stagnant or occasionally dipping,
then HHIs make sense.
Right. HHIS serves a purpose. Harvest manages it well for what it is designed to do. I mean, it has avoided the severe net asset value collapse that many critics originally feared when a leveraged 26% yielding fund was announced.
But for Blueprint to Escape, our core perspective is really centered around a no capital loss philosophy. High yield is attractive, but the data clearly shows that HTA proves to be the solid core tech income generator.
It protects the base.
It preserves and actually grows the underlying capital engine while still paying a very respectable distribution.
It's also worth noting how resilience factors into long-term planning. Despite tough market periods over the past year, both funds actually managed to increase their cash distributions.
But it's great news.
Yeah, HTA, for instance, already bumped its monthly payout from 14 cents to 16 cents earlier this year.
Which is a clear sign that the underlying assets inside HTA are fundamentally healthy.
They are, and this raises an important question regarding how distributions might change. Given HTA's strong recent surge in price return, growing that 20% harvest may find themselves in a position where they need to increase the cash distributions again.
To maintain the yield?
Exactly. If the fund is targeting a yield of roughly 8.4 to 10%, and the share price goes up significantly, the actual cash payout has to increase just to keep the percentage yield mathematically steady.
Capital growth forcing a dividend raise. That is a highly favorable problem for an investor to have. So based on this case study, we have a clear path forward.
The Blueprint Action Plan.
Yes, the Blueprint to Escape action plan for the coming months is an adjustment in balance. The plan is to maintain exposure to both for now, but to gradually move a bit more of the current HHIS holdings over to HTA.
Shifting the weight.
Right. The objective is to favor that core stability and consistent capital growth while still collecting a reliable income stream. We are shifting capital from the drag racer back into the reliable hybrid vehicle.
It's a calculated tilt that honors the mechanics we discussed. By reducing the portfolio's reliance on the leveraged high-volatility engine of HHIS and leaning into the equally weighted efficiency of HTA, an investor can really secure their foundational capital.
You get to keep your engine intact.
You participate in the technology sector's gains rather than capping them away for a few extra points of yield.
It's about choosing the right vehicle for a long-distance journey. But what about you? What are your views on HTA versus HHIS after looking under the hood? Do you agree with this tilt toward core stability?
Or do you prefer to manage the volatility for that massive 26% yield?
We would love to hear your perspective, so please post your comments or questions. Let us know your favorite income strategy. And if you are focused on the mechanics of building real wealth, please subscribe for more content about financial independence, passive income, early retirement, and nomadic life design.
Discussing these different approaches and testing our assumptions is really how we refine our strategies.
Absolutely. Also, a quick reminder that the current full portfolio is available in the description section below. We do our monthly income portfolio reveal around the 20th of each month, where we detail the major moves being made to optimize both stability and income. Before we wrap up, any final thoughts on the trade-off between growth and yield?
As we conclude our analysis of these two funds, I want to leave the listener with a final thought to consider. As equal-weighted strategies like HTA increasingly outpace leveraged, concentrated funds in price return during market recoveries, we have to ask ourselves a difficult question.
Okay, let's hear it.
In the pursuit of financial independence, at what point does relentlessly chasing yield actually start costing us the very wealth we are trying to build?
A perfect reminder to always look past the dashboard and understand the engine. Thank you for joining us for another case study, and we will see you next time.